Why 4 rate hikes next year?
Basically, what we're saying is they're going to keep doing what they've been doing. They've been hiking or starting the balance sheet runoff every quarter since the fourth quarter of 2016. And with the economy actually growing more quickly than it has for most of the past year, I think you're going to see further downward pressure on the unemployment rate. They lowered the unemployment numbers to 3.9% for the end of next year, but I think there's still more downside. We think it's going to fall more sharply. And so while Chair Yellen said bringing inflation up to 2% is an important priority, and we don't think it's going to quite get there in 2018, it's also an important priority to stabilize the labor market. They now think that the labor market has, just about improved as much as it really can on a sustainable basis.
4 rate hikes next year. Does that mean an inverted U.S. yield curve?
I don't think so, because if they do more than what markets are pricing at the moment, and if markets basically believe that the data justify what they're doing, then the expected level of short-term rates over the next 10 years is also going to drift somewhat higher. That has an impact on the long end of the yield curve. And then I think in addition to that, the term premium, which Chair Yellen also referenced in her press conference, probably also has some room to normalize. So I do think that you'll see somewhat higher yields really across the yield curve and not an inverted curve.